LLCs are super popular and highly valuable and incredibly flexible, but they're not the only game in town. And in recent months, there's been a big upswing away from LLCs to S corporations. And so people have been asking me about that. So I wanted to just address a little bit about what an S corporation is, why it's a very, very powerful tool, and why I use C corporations, S corporations, and limited liability companies in the things that I do. And there is no one size fits all. It's what's right for the job. So let's just talk about S corps for a minute. Okay, an S corp is a C corp. It's a C corporation, a regular corporation that is filed, and then the owner or owners want a simplified way of dealing with their tax reporting. So they file a form with the Internal Revenue Service. It's a 2553. Write that down, 2553 form, which is the S election, okay? S election. What happens when you switch from a C Corp to an S Corp is where the C Corp has its own tax scheme, right? They're its own tax brackets. There's the ways that it has to do its own tax return like a paper person, right? It has its own deal separate from you. There can be double taxation with a C Corp. There can be a number of challenges for a small, closely held company with a C Corp. C Corps are great. I use them. I love them. There's a place for them. For a kind of a single owner business or a mom and pop kind of business where you want the money from this project you're doing to mix in with maybe W-2 income from you or your spouse or both. Maybe you've got some money coming in from some multi-level marketing thing you did a few years ago, but there's still $1,200 a month coming in. You've got the oil well lease that Grandma and Grandpa left you in Oklahoma, and that's, $1,000 every 3 months. You just have all these disparate streams of income. And the cool thing about an S Corp is all of the things in this business you're doing can meld in with all the other stuff. Typically on your Schedule C, there are several different schedules where it may show up on your personal tax return, but usually Schedule C, all those gains and losses from all those things all kind of settle out and you get to a flat number. Instead of having to have individual tax returns for all those circumstances, it all just comes to one place, kind of levels out, and you report on that. So then the question, another benefit, I should say before I give you another fun topic, is one of the advantages of an S Corp is that you can become an employee of the S Corp. You can become a W-2 employee. Even if you're the shareholder, you can also be a W-2 employee of the company. So the question is then, when do I become an employee? When's the right time to start acting like that? And instead of just taking distributions from the company, when do I get myself set up on paychecks, pay stubs, and there's withholding and my Social Security and Medicare is getting pulled out, paid for by the company, by the way, half of it, instead of 100% from you. A good rule of thumb, and it's going to be different for everybody, so I'm not giving you specific tax advice, but a good rule of thumb is that when the amount you're going to be distributing from the company to you gets to be $40,000, $50,000 a year, it's starting to be less expensive to pay payroll taxes because of the higher dollar amount than it is to pay self-employment tax on smaller amounts. Self-employment tax is the most expensive way to be taxed on income. You want to get past it quickly, but when you're only able to give yourself $10,000, $20,000, $30,000 a year, you're just getting started. You can just start to feed yourself a little bit. Self-employment taxes will be lower than payroll taxes. But as you get up around $4,000 a month, $4,000, $5,000 a month and up, it becomes less expensive to pay payroll taxes and have all of your federal withholdings, primarily Social Security and Medicare, Medicaid, FICA, FUTA, they call it. It's cheaper to have the company pay some of that with pre-tax money, half of it with pre-tax money. You still have it withheld from your check, but now the payroll costs are lower than self-employment tax. So the cool thing about an S Corp is it simplifies your tax reporting. And if you're making very much money at all, it doesn't even have to be a lot of money, but if you're making enough to pay yourself $4,000 or $5,000 a month consistently, steadily, where you can do that on a paycheck, it becomes a tax benefit for the company to be bearing some of the weight instead of you bearing all of the weight. So many small business owners that I know just take distributions out of the company when they can. So maybe this month you take zero, and next month you take $15,000. And then the next month you take 8,000. Then the next month you take zero. And then the next month you take 3. And the next month you take 20. And it's this roller coaster thing, and it becomes challenging to keep track of. You're going to need to be doing quarterly estimates when you're all over the place like that. But if you get set up where you can be on payroll, and just get on payroll for what's predictable. So let's say it's $4,000 a month. You know that even with the crazy ups and downs of revenue, you could consistently pay yourself $4,000 or $5,000 a month. That's a good time to get onto pay stubs, become an employee of the company, have the company do the withholding. So the pre-tax money of the company's paying half of your obligations to the government. The other half is being taken out of your payroll check. Then if there's more money that you still need to take from the company, you can choose to take bonuses, distributions, loans. There's a bunch of ways you can take money out of a company besides your payroll. The good news about being on payroll, instead of just being self-employed with this crazy roller coaster of income, is that when you go to get a car loan or a house loan or apply for a credit card or any number of things, you can just say, I'm an employee. I have a job working for this company. That can benefit you and dramatically speed up your access to borrowed capital. It also reduces your disclosures, having to give 3 years of tax returns and so on in order to get that loan as a self-employed person. Becoming employed is a big benefit. Get to a place where there's predictable revenue so that you can make sure you can do it every month, and then get onto pay stubs, in my opinion, as quickly as you can, up to a certain level. And that's for a different video. But when you get to a place where you're making more money, then you really need to live the life you want to live with things that should come out of your paycheck. Things like your house payment, your primary residence house payment. Things like certain kinds of expenses for vacations and stuff that really there's no way to justify as a business expense. You want to be on pay stubs up to that. When you get above that level, that's when you start using strategies for distributions or loans from the company, any number of other mechanisms that can be organized so that more of your life is paid for with pre-tax money and expense to the company versus after-tax money and expense on your household. There's so many things we could go down a path on there. If you have questions, you want to write to me and ask questions, write to Aaron Young at Laughlin USA, or go to the websites, come to the events. We read my books. We have all kinds of ways we can dive into this, and you can start getting strategic ideas of how to, in your specific situation, live more of your life with pre-tax money, be getting all the benefits of being an employee of one of these companies that you've got set up, and just get all the benefits that come with being a business owner. Hopefully that was really helpful today. Please leave messages in the comments, ask questions, like, subscribe, do all those kind of things so that more and more people get access to this information. And that's it for today. I look forward to seeing you on the next show.